Nvidia has become one of the most consequential companies in the global economy. Its graphic processing units are the essential infrastructure for artificial intelligence training and inference. The largest technology companies in the world, Amazon, Google, Microsoft, Meta, they're all collectively spending hundreds of billions of dollars on AI infrastructure, and a very large portion of that spending flows directly to Nvidia's GPU products. For market participants, Nvidia is more than just a single stock. It is a barometer for the AI investment cycle, for semiconductor demand broadly, and for the health of the whole technology sector. In this video, we go beyond the stock price and we build a genuine understanding of the semiconductor cycle, the AI infrastructure build-out, where Nvidia's competitive moats actually come from, and critically, what could challenge them. The single most important driver of Nvidia's recent performance is the AI infrastructure build-out by the world's largest technology companies. Amazon, Microsoft, Alphabet, and Meta have collectively announced capital expenditure plans approaching $700 billion for 2026. That spending is growing at an extraordinary pace. Combined capex for these companies nearly tripled from approximately $162 billion in 2022 to over $448 billion in 2025, according to data compiled from the SEC filings. Nvidia is the primary beneficiary because its GPUs are the dominant hardware for training and running large language models. When hyperscalers build new data centers optimized for AI, they fill them primarily with Nvidia chips. The scale is genuinely unprecedented in technology industry history. The question is not whether it's happening, it's clearly happening, but whether the demand is sustainable, whether the returns on the investment are going to materialize, and whether Nvidia's competitive position will remain as dominant as it is today. Most analysis of Nvidia focuses on its hardware. The real moat is software. Nvidia's CUDA platform, which stands for Compute Unified Device Architecture, is a programming environment that allows developers to write code that runs on Nvidia GPUs. It's been available since 2006. Over nearly 2 decades, millions of AI researchers, data scientists, software engineers have learned to write in CUDA. Tens of thousands of software libraries, frameworks, and tools have been built on top of it. This software ecosystem is self-reinforcing and extraordinarily difficult to displace. Even if a competitor produces hardware with equal or superior performance on paper, switching costs are enormous. Writing production AI code from CUDA to a new platform is not a trivial exercise. It takes months of engineering time and introduces significant risk of errors. This is why Nvidia's competitive position is more durable than hardware comparisons suggest. You're not just competing with the chip, you're competing with nearly 2 decades of accumulated software investment by the entire AI development community. Nvidia's dominant position is not uncontested, and understanding the competitive dynamics is essential for a clear view of the sector. AMD has been developing competitive AI GPU products and has been gaining traction with hyperscalers who want to reduce dependence on a single supplier. Intel is investing heavily in AI chip development, though it remains behind in current product competitiveness. Perhaps more significantly, the hyperscalers themselves are developing custom AI chips. Google has TPUs, Amazon has Trainium, Inferentia, and Microsoft has Maya chips. They're all designed to reduce the reliance on Nvidia for specific workloads. Now, as these custom chips improve, some portion of AI workloads will shift away from third-party GPUs. This is normal, and it's expected in technology markets. It does not mean Nvidia's leadership disappears. The CUDA ecosystem advantages are real and durable, but it does mean the runway for uncontested market dominance is finite, and the rate of market share erosion is something investors need to monitor carefully. At any given market price, the fundamental question about Nvidia is whether its valuation reflects the realistic long-term earnings power of the company or whether it prices in an overly optimistic scenario. Nvidia's revenue has grown at extraordinary rates. Driven by insatiable demand for its AI chips, its gross margin have been among the highest ever recorded for a hardware company. These are genuine strengths that support a premium valuation. But valuation is always relative. When a company trades at a very high multiples of current earnings, the market is pricing its sustained high growth for years into the future. If that growth slows, if AI spending plateaus, if competitive pressure increases, or if new chip architecture emerges that reduces Nvidia's advantage, the downward repricing can be significant, even if the underlying business remains strong. This is the classic technology cycle dynamic. Great companies at reasonable valuations are long-term wealth creators. Great companies at extreme valuations can disappoint investors for years, even as the business performs well, simply because the entry price has already captured the optimistic scenario. The question to ask is not, is Nvidia a great company? It clearly is a great company. The question is, What growth rate has the current stock price already priced in? And is that growth rate realistic over the relative holding period? Nvidia and the semiconductor cycle represent one of the most significant investment themes in global markets today. The AI infrastructure build-out is real, the demand is genuine, and the technology is transformative. These are not hypothetical future benefits. They are already generating enormous revenue for companies building and selling AI capabilities. The open questions are valuation and duration. How long does the build-out continue at this pace? When does competitive pressure begin to erode margins? When does the hyperscaler spending cycle plateau? For traders, watch quarterly earnings from the major hyperscalers for any signs that AI infrastructure spending is moderating. Watch AMD's GPU market share for signs that competition is gaining traction. Watch Nvidia's own gross margins, because any compression there will be one of the earliest signals that pricing power is under pressure. What's your view on the AI semiconductor cycle? Drop it in the comments below, and we'll see you in the next video.